Have you ever noticed how the people who seem to have their financial lives together never talk about money, while the ones drowning in debt won't shut up about their latest cryptocurrency investment or get rich quick scheme? There's something deeply ironic about that, isn't there? The truly wealthy whisper while the broke shout from rooftops about their financial genius. Well, here's something that might surprise you. Financial freedom isn't about making millions of dollars or discovering some secret investment strategy that Wall Street doesn't want you to know about. It's about following a set of simple, boring rules that most people ignore because they're too busy chasing the next shiny object. These rules aren't glamorous, they won't make you rich overnight, and they definitely won't impress anyone at parties, but they work. My name is Nick, and I've spent years studying the habits of people who actually achieve financial independence, not the ones who just talk about it online. What I discovered is that there are 19 specific rules that separate those who build lasting wealth from those who spend their entire lives wondering where their money went. These aren't complicated formulas or advanced investment strategies. They're simple habits that compound over time into something extraordinary. Now, I know what you're thinking. 19 rules sounds like a lot, and you're probably expecting me to tell you to stop buying coffee or cancel Netflix. But here's the thing that makes this different from every other financial advice video you've watched. These rules aren't about deprivation or living like a monk. They're about making intentional choices that free up your most valuable resource, which isn't money. It's your future options. By the end of this video, you'll understand exactly why some people break free from the paycheck to paycheck cycle, while others remain trapped forever. More importantly, you'll have a clear roadmap for joining the first group. But I have to warn you about something. Once you start following these rules, you're going to notice just how differently you think about money compared to everyone around you, and that can be uncomfortable at first. The first rule is to build an emergency fund, and this is where most people immediately roll their eyes and click away. I get it. Emergency funds are about as exciting as watching paint dry. But here's what financial advisors don't tell you about emergency funds. They're not really about emergencies at all. They're about freedom. When you have 3 to 6 months of expenses sitting in a boring savings account, something magical happens to your decision-making process. You stop making choices from a place of desperation. That terrible job with the micromanaging boss, you can actually consider leaving because you won't be homeless next month. The side business you've been thinking about starting, you can take that risk because you won't starve if it doesn't work out immediately. Most people think an emergency fund is just for car repairs or medical bills, but the real power of an emergency fund is that it transforms you from someone who reacts to life into someone who responds to opportunities. There's a massive difference between those two approaches, and it shows up in your bank account over time. The second rule is to prioritize paying off high interest debt, and this is where things get mathematically brutal. If you're carrying credit card debt at 20% interest, you need to understand something that credit card companies really don't want you to figure out. Every dollar you owe them is costing you exponentially more than just the balance on your statement. Let's say you have $5,000 in credit card debt at 20% interest and you're making minimum payments. If you continue on that path, you'll end up paying over $13,000 total. That's $8,000 in pure interest. $8,000 that could have been invested, could have grown, could have worked for you instead of against you. But here's the part that really stings. While you're paying that $8,000 in interest over the years, if you had invested that same money in a simple index fund averaging 8% returns, it would have grown to over $14,000. So that credit card debt didn't just cost you $8,000, it cost you the opportunity to make $14,000. The real cost is over $22,000. This is why paying off high interest debt isn't just about getting out of a hole. It's about stopping the bleeding so you can actually start building wealth. Every month you carry high interest debt is another month you're working for the credit card company instead of working for yourself. The third rule is to live below your means, and this is probably the most misunderstood concept in all of personal finance. Most people think living below your means is about being cheap or depriving yourself of everything enjoyable. That's not what this means at all. Living below your means is about spending less than you earn so you can invest the difference. It's about understanding that every dollar you spend on something temporary is a dollar that can't work for you permanently. But here's the key insight that changes everything. You don't have to dramatically reduce your lifestyle to live below your means. You just have to be more intentional about where your money goes. The average household spends money on hundreds of things every month without really thinking about whether those things add value to their lives. Subscriptions they forgot about, convenience purchases that seem small but add up, lifestyle inflation that happens so gradually they didn't even notice it. Living below your means is about paying attention to these patterns and making conscious choices instead of unconscious ones. The fourth rule is to automate your savings and investments. And this might be the most powerful rule on the entire list. Automation removes the biggest obstacle to building wealth, which isn't lack of knowledge or lack of money, it's lack of consistency. When you manually decide whether to save or invest money each month, you're relying on willpower and motivation. Like some months you'll feel motivated and save aggressively. Other months, life will get in the way and you'll tell yourself you'll catch up next month. But next month never comes, and before you know it, years have passed without meaningful progress. Automation solves this problem by removing the decision entirely. When money is automatically transferred from your checking account to your savings and investment accounts before you even see it, saving becomes effortless. You adapt to living on what's left over, and your wealth grows without requiring constant attention or motivation. The fifth rule is to save at least 20% of your monthly income, and I can already hear the objections. 20% sounds impossible when you're living paycheck to paycheck. But here's something interesting about that 20% target. It's not arbitrary, it's based on the mathematics of compound growth and the reality of how long most people work. If you save 20% of your income and invest it wisely, you can potentially retire in your 40s or early 50s instead of working until your 70s. That extra decade or two of freedom is worth making some sacrifices for, but even if early retirement isn't your goal, 20% provides a substantial buffer against life's uncertainties while building wealth that creates options. The sixth rule is to drive a cheap, reliable car, and this is where I lose about half my audience. Americans have a bizarre relationship with cars that borders on the irrational. We've somehow convinced ourselves that our vehicles are extensions of our personalities rather than tools for transportation. Here's the brutal math on car payments. The average new car payment is over $700 per month. Over 5 years, that's $42,000, not including insurance, maintenance, and depreciation. If you bought a reliable used car for $15,000 and invested that monthly payment difference, you'd have over $60,000 after 5 years. That's enough for a down payment on a rental property or a substantial addition to your retirement account. But the real cost of expensive cars goes beyond the monthly payment. They trap you in a cycle where you need to maintain a certain income level just to make the payments. This reduces your flexibility to take risks, change careers, or start businesses. A reliable car that's paid off gives you freedom. A fancy car with payments gives you stress. The seventh rule is to cut unnecessary expenses, and this is where you discover just how much money disappears into thin air every month without you even noticing. Now, most people have no idea where their money goes. They just know that somehow, despite making a decent income, they always seem to be broke by the end of the month. Here's a fun exercise that will probably terrify you. Go through your bank statement from the last 3 months and categorize every single expense, not just the big ones like rent and groceries, but everything. That $12 for premium parking because you were running late. The subscription to that meditation app you used twice, the convenience store purchases when you could have planned ahead, the delivery fees because cooking seemed like too much work. What you'll discover is that a shocking amount of your income is going toward things that add zero value to your life. These aren't conscious choices you made after careful consideration. They're the result of 1,000 tiny decisions made when you were tired, rushed, or just not paying attention. The average person could probably cut 15 to 20% of their monthly expenses without changing their lifestyle at all, just by eliminating waste. The eighth rule is to diversify your investments, but not in the way most people think. When financial advisors talk about diversification, they usually mean spreading your money across different types of investments. So you're not putting all your eggs in one basket. That's important, but there's a deeper level of diversification that most people miss entirely. Real diversification means not just diversifying your investments, but diversifying your income sources, your skills, and your opportunities. Having all your income come from one job, no matter how secure that job seems, is actually incredibly risky. Companies downsize, industries become obsolete, and economic conditions change. The people who build lasting wealth understand this and create multiple streams of income over time. This doesn't mean you need to start 5 businesses tomorrow. It means thinking strategically about how to gradually reduce your dependence on any single source of income. Maybe you develop a skill that could become freelance income. Maybe you invest in dividend-paying stocks that provide passive income. Maybe you buy rental property that generates monthly cash flow. The specific strategy matters less than the principle of not having all your financial eggs in one employment basket. The ninth rule is to never invest in what you don't understand. And this is where most people destroy their wealth while thinking they're building it. Every few years, there's some new investment trend that promises incredible returns with minimal risk. Cryptocurrency, day trading, real estate flipping, whatever the flavor of the month happens to be. Here's what always happens. People hear success stories about someone who made a fortune. They get excited about the potential returns and they throw money at something they don't actually understand. Then they lose money, blame the investment, and conclude that investing is just gambling for rich people. But successful investors do the opposite. They stick to simple, boring investments that they completely understand. They buy index funds that track the entire stock market. They purchase rental properties in areas they know well. They invest in their own education and skills. They're not trying to get rich quick. They're trying to get rich slowly and predictably. The 10th rule is to stay informed about the financial world. But here's the catch. Most financial media is designed to make you feel stupid and scared. So you'll pay for advice or products you don't need. The financial news cycle thrives on creating urgency and fear because that's what keeps people watching and clicking. Real financial education is different. It's about understanding fundamental principles that don't change, regardless of what's happening in the markets on any given day. It's about learning how compound interest works, how inflation affects your purchasing power, how taxes impact your returns, and how different investment vehicles actually function. You don't need to become a financial expert, but you do need to understand the basics well enough to make informed decisions about your own money. This means reading books written by people who have actually built wealth, not just people who talk about building wealth. It means learning from investors who have succeeded over decades, not traders who had one good year. The 11th rule is to take calculated risks, and this is where the difference between wealthy people and everyone else becomes crystal clear. Poor people avoid risk because they can't afford to lose. Rich people take risks because they can afford to lose. But middle-class people often take the wrong kinds of risks while avoiding the right ones. They'll spend $40,000 on a car that depreciates rapidly, but they won't invest $10,000 in an index fund because it's too risky. They'll take out massive student loans for degrees with uncertain job prospects, but they won't start a side business because it might fail. They'll keep all their money in savings accounts, losing value to inflation because the stock market is scary. Calculated risk means understanding the potential upside and downside of your choices, then making decisions based on logic rather than emotion. It means taking risks that have limited downside but unlimited upside. Starting a business with a small initial investment, learning high income skills that can't be automated, investing in assets that have historically grown in value over time. The 12th rule is to start a side hustle or business alongside your regular job, and this is where you can accelerate your wealth building beyond what's possible with just saving and investing your salary. Your job gives you security and steady income. Your side business gives you unlimited earning potential and tax advantages. The beauty of starting a side business while keeping your day job is that you can afford to be patient and strategic. You're not desperate for immediate income, so you can focus on building something sustainable rather than just grabbing quick cash. You can reinvest profits back into the business to help it grow. You can experiment and learn without risking your ability to pay rent. But here's what most people get wrong about side businesses. They try to start businesses in areas they know nothing about because they think those industries are more profitable. Like the dentist tries to flip houses, the teacher starts a drop shipping business, the accountant becomes a day trader. Usually this approach ends badly because they're competing against people who actually understand those businesses. The smart move is to monetize knowledge and skills you already have. The dentist could consult for other dental practices. The teacher could create educational content. The accountant could offer bookkeeping services. Start with what you know, then expand from there once you understand how business actually works. The 13th rule is to never quit your day job without a plan. And this might be the most important rule for people who have entrepreneurial ambitions. Social media is full of stories about people who quit their jobs to pursue their dreams and achieved massive success. What you don't hear about are the thousands of people who quit their jobs without proper planning and ended up broke, stressed, and forced to take worse jobs just to survive. Your day job isn't just providing income. It's providing health insurance, retirement benefits, and financial stability while you build something else. Like giving up those benefits without a solid plan is usually a mistake, especially if you have family depending on you. The smart approach is to build your alternative income source while keeping your job, then transition gradually when the numbers make sense. This means having at least 6 months of expenses saved, having your side business generating consistent income for several months, and having a clear plan for health insurance and other benefits. It means understanding that entrepreneurship is often more about managing risk than taking risk. The most successful entrepreneurs aren't gamblers. They're people who stack the odds in their favor before making big moves. The 14th rule is to negotiate a raise or find higher paying work, and this is where most people leave thousands of dollars on the table every year. They accept whatever salary is offered, never ask for raises, and assume that their employer will automatically reward good performance with better compensation. Here's reality. Your employer's job is to pay you as little as possible while keeping you happy enough to stay. Your job is to demonstrate your value and ask for compensation that reflects that value. This isn't greedy or unreasonable. It's just business. If you don't advocate for yourself, nobody else will. But negotiating isn't just about asking for more money once a year during your performance review. It's about consistently documenting your achievements, taking on additional responsibilities, and making yourself indispensable. It's about researching what other people in similar roles are earning and presenting a compelling case based on data, not just feelings. And if your current employer won't pay you what you're worth, then it's time to find someone who will. Job hopping every few years used to be seen as a red flag, but in today's economy, it's often the fastest way to increase your income. People who stay at the same company for decades often find themselves earning significantly less than new hires doing the same work. The 15th rule is to create a 12-month financial plan, and this is where you stop letting money just happen to you and start making intentional decisions about your financial future. Most people live in a perpetual state of financial reactivity. Something unexpected comes up, they scramble to figure out how to pay for it, then they forget about planning until the next crisis hits. A financial plan doesn't have to be complicated. It just needs to answer a few basic questions. How much money do you expect to earn this year? How much do you plan to save and invest? What major expenses are coming up that you need to prepare for? What financial goals do you want to accomplish in the next 12 months? The act of writing this down forces you to be realistic about your situation and intentional about your choices. It also helps you identify potential problems before they become actual problems. Maybe you realize you're going to need a new car next year, so you can start saving for it now instead of panicking when your current car dies. The 16th rule is to learn the tax code because it's actually written to your advantage if you know how to read it. Most people think taxes are just something that happens to them, like bad weather or aging, but the truth is, the tax code is full of incentives designed to reward certain behaviors that the government wants to encourage. Starting a business? There are deductions for that. Investing in real estate, tax advantages everywhere, contributing to retirement accounts. The government will literally reduce your tax bill for doing something that benefits your future self. But you can't take advantage of these opportunities if you don't know they exist. You don't need to become a tax expert, but you should understand the basics of how taxes work and how different financial decisions affect your tax situation. This knowledge can save you thousands of dollars every year, which is money that can be redirected toward building wealth instead of funding government programs. The 17th rule is to sacrifice luxuries to free up more money for investments. And this is where we separate the people who are serious about building wealth from those who just like talking about it. Everyone wants to be financially free, but not everyone is willing to make the short-term sacrifices necessary to achieve long-term freedom. This doesn't mean living like a hermit or never enjoying anything. It means being strategic about where you spend your discretionary income. That expensive vacation you're considering, maybe take a cheaper trip and invest the difference. That designer handbag or latest gadget you want, maybe wait 6 months and see if you still want it. All right, often you won't. The key insight here is that every luxury purchase is a trade-off. You're choosing immediate gratification over future freedom. Sometimes that trade-off is worth it, but most of the time it's not. The wealthy understand this instinctively. They're not cheap, they're strategic. The 18th rule is to read books on money, finance, and investing because your financial education didn't end when you left school. In fact, it probably didn't even begin there. Most schools teach you how to be an employee, not how to build wealth. If you want different results than most people get, you need to learn things that most people never learn. The good news is that every successful investor and entrepreneur has written about their strategies and mistakes. You can learn from their decades of experience for the cost of a book and a few hours of your time. This is probably the highest return on investment you'll ever make. But here's the important part. Don't just read one book and think you're done. Make learning about money a lifelong habit. The financial world is constantly evolving, and what worked 20 years ago might not work today. Stay curious, stay learning, and stay ahead of the curve. The 19th and final rule is to donate to your favorite charity monthly. And this might seem counterintuitive in a video about building wealth. Why would you give money away when you're trying to accumulate it? But there's something powerful that happens when you make charitable giving a regular part of your financial routine. First, it forces you to live on less than you earn, which accelerates your wealth building in other areas. Second, it creates an abundance mindset that attracts more opportunities. And third, it ensures that your pursuit of financial freedom doesn't turn you into a selfish person who only cares about accumulating money. The amount doesn't have to be huge. Even $50 or $100 a month can make a meaningful difference to an organization you care about while reinforcing positive money habits in your own life. There you have it. 19 rules that separate those who achieve financial freedom from those who spend their lives wondering where their money went. These aren't revolutionary concepts or secret strategies. They're simple, boring habits that work precisely because they're simple and boring. The question isn't whether these rules work. The question is whether you're disciplined enough to follow them consistently over time. Your future self is counting on the answer being yes.